Today, I'm going to answer the question that I get asked every single day. John, what the heck is going on with mortgage rates and why have they gone up so quickly? Especially given the fact that the Fed has only raised their rate by 1/4%, but just this week we saw a 0.5% increase in mortgage rates. Why is that happening? The first thing I'll tell you is we are in unprecedented times. We're dealing with four major issues right now that over the last 4 decades, we dealt with each one of them individually, and right now we're dealing with them simultaneously. We have an oil crisis similar to what we had in the 70s. We got inflation similar to what we had in the 80s. We've got a stock market correction similar to what we had in the late 90s. And we've got a major nosedive with housing affordability that we dealt with in the early 2000s. All four of those things are happening at the exact same time. This does have something to do with the Fed, but not for the reason that you think. So let me share with you what's going on here. First of all, the Fed funds rate has gone up a lot higher in the past. And obviously this was in the 1980s with inflation, but what the Fed charges on their funds rate is what banks pay to borrow money from the federal government for one day, overnight. And we're talking about a rate that has been historically at, for the last 2 years, it's been at 0 to 1/4%. Now it's between 1/4 and 1/2%. This is not the reason that rates are going up. There's another thing the Fed is doing that is actually causing mortgage rates to go up significantly, and it is the fact that they, starting in 2000, were buyers of mortgage bonds. They were the buyers, they were the investors that were buying the mortgage loans when lenders like me would create a mortgage for you. They would be the investor on the other end that would buy them. Why did they do that? Because they wanted to support the economy when they were worried about us heading into COVID. They did this back at the housing crash a decade ago, and they did this so that they can provide liquidity. They can provide money into the mortgage market to help lower interest rates because they were buying mortgages. We didn't need to charge as much in interest because we had a strong buyer that was willing to take those loans at a very low interest rate. Well, the Fed has now said, stop. We're no longer going to buy mortgages. We knew that 3 months ago. But the biggest issue is they continue to get more and more serious about the reinvestments of the mortgages that are getting paid back. So I want you to think about this analogy real quick. Pretend that you have a mortgage, and every single month you pay back your mortgage payment, and a portion of it goes towards principal. That's paying down the balance. The bank then can turn around every month and use that money to reinvest in more mortgages, to loan that money to somebody else. That's essentially what the Fed does. So they were buying brand new mortgages, and they were also taking the money that they were getting back in principal payments every month and using those to buy even more mortgages. So they kept their balance sheets stable. When they stop buying new mortgages, they actually continue buying new mortgages by reinvesting the money they get paid back in principal every single month. Now they're saying they're going to stop that cold turkey, and that is freaking out the markets. And we are having a withdrawal symptoms basically because we've had a huge buyer that's been buying these mortgages, and they're now saying, hey, not only am I not going to continue buying brand new ones, but I'm actually not going to reinvest the money that I have been getting paid back every single month. Let me show you what this looks like, guys. This is a chart of the average 30-year fixed rate mortgage. So I'll hide my picture here real quick. So what we're seeing is going back here, and this is going to a year ago. So March of 2021, and if you look on the far right side, you'll see the number, and it says 3.29%. So we were at 3.2, went up to 3.4. We were down as low in August to 2.74%, and then rates started going up, but we were still really, really good until we hit December. So we were around 3.25, pretty normal. This is the normal fluctuation we're going to see from a low of 2.75, and then a couple weeks later we're at 2.99, maybe 1/4%. Here we're at 3.1 over a month's period. We normally move in smaller increments like this. But what we're seeing is a significant jump, and I'm going to go back to just March. So I'm recording this on March 26th, and on March 1st, rates were at 3.89. Today, they're at 4.95. We have seen a 1% increase in mortgage rates, and a good portion of that was just in the last week. So if I go back to March 18th, we were at 4.57 on March 18th. That's the average interest rate. We're seeing a huge increase in interest rates. What's it going to take for this to stop? Here's what I'll tell you. The Federal Reserve, the first tool that everybody focuses on is the Fed funds rate. The Fed is raising their funds rate because they're trying to slow the economy. They're trying to slow people's purchases of things on their credit card because the Fed funds rate is going to increase the interest rate on your credit card. It's going to increase the interest rate on your home equity line of credit, and you're not going to buy as much stuff. That is going to slow down inflation at some point when they raise their funds rate high enough to get people to say, you know what, I got to stop. I can't spend anymore. And that inflation is what is going to, is right now driving rates up, that we're going to turn around and slow it down. So I think we are pretty close to the high end of where I see rates going. Obviously, all bets are off as we have some wild cards out there, but I think we're going to land somewhere in the mid fives. So we're touching 5%. I think we're going to land somewhere in the 5 to 5.5% range. But right now, we are essentially hearing the Fed say, hey, we're taking the nuclear approach. We are doing serious things to to raise interest rates to slow down the economy. And the mortgage market is reacting to that now. That doesn't mean we're going to see rates go up even more as the Fed actually raises their rates. We are raising rates now in anticipation of what the Fed is going to do. And typically, as long as the Fed doesn't surprise us with any new information saying, hey, we're taking the nuclear option and multiplying it times 2, that's where we get worried. That's where we have wild cards come in that will cause interest rates to go up even more. But I think right now the Fed's really said we're pulling out all the stops. We're doing everything possible to stop inflation. But in the short term, that means that they are stopping buying mortgage bonds. They're stopping the reinvestment into mortgage bonds, and they're going to significantly raise rates on everything. And the market this week, last week, this month has been a significant reset, the biggest increase, single week increase in interest rates we've seen since 1994. This is really unprecedented territory that we're in. I feel like we're kind of approaching the top of where this is going, but I don't see rates coming down anytime soon. So if you're thinking about, hey, if we're approaching the top, maybe I'll wait until it goes down, I don't see that happening. Also, if you're thinking, hey, I'll wait until housing prices drop more, check out my YouTube channel. I've got a video there that talks about the future of housing prices. I think we have prices continuing to increase for the next 3 to 4 years. So we're not going to see prices drop anytime soon, and we're not going to see interest rates drop soon. I just feel like we're getting close to the top unless there's really more bombshells the Fed's going to introduce, but only time will tell. Thanks for listening. Make sure you like and subscribe. Like this video, subscribe to my channel, and click the notification bell next to subscribe on YouTube so that you can get notified every time I post something new. Have a great day.